Good evening, respected colleagues. This is Den Strelkov, as always with the ForexTimes project, and I have a small announcement. Starting next trading week, the project for the automatic duplication of transactions begins. Respected colleagues, I will publish another video in which I will talk about this project and how to join it, how to set up your own with propriety. If you really need answers today, tomorrow, the day after tomorrow, you can contact me personally for any consultation. Also, feel free to private message me on Telegram. I'll be happy to advise and would be glad if you join the new project of automatic deal copying. Well then, let's get started as we always do. Looking at the likely movements of trading instruments. As always, we will be looking at gold and the Swiss franc, which I find the most appealing out of all this trinity. So here we go, the euro against the US dollar. First of all, we will look at the Commodity Futures Trading Commission reports, which show that buyer numbers have decreased by 39%. And this is a key point that will now affect everything that I will be talking about afterwards. Specifically, it is very likely that we have formed an impulsive movement of 1, 2, 3, 4, 5. Even though there's been a very small fourth corrective wave, it is still most likely an impulse. There are currently two possible scenarios for the future, a conservative one and a more risky one. The more risky scenario assumes that the corrective drop in ABC waves has already ended at the mark, so ABC. At the 50% mark on the Fibonacci grid, at this moment, we've seen growth already in the third wave, the first wave, the second and the third senior order wave. Thus, we've seen impulsive growth. Now, a correction is developing, after which growth will occur again. The first risky option is a pending buy stop order based on wave C with stop loss under the completion of wave C. In this way, if our impulse continues to develop, it catches the pending buy stop order and grows in the senior order wave. If the correctional movement continues to evolve, then we move to the conservative scenario. Namely, the correctional movement could occur in a double zigzag. Zigzag number 1 and zigzag number 2. In zigzag number 2, we could potentially reach, I beg your pardon, the 78.6% Fibonacci level. Also located here is the market maker's loss level, the bottom range of market maker profit. The market maker will most likely protect it, so its arrival here will most likely provoke a purchase. I'll be more than happy to enter the market. Specifically, I'll wait for the impulse correction and then set a pending buy stop order, and I'll put a stop loss right here. Respected colleagues, there are two options, and you can choose either one for yourself, essentially. The first, buy, is more risky. The second is more conservative. Choose whichever one you prefer. Unfortunately, I don't have anything interesting or good to say about gold for the simple reason that the last wave which formed after the triangle is still ongoing. As you know, the triangle is the penultimate wave. Based on the triangle, we can draw the median line of the triangle, which often serves as the target level for the price. But at what point the price will turn around is a big question. Respected colleagues, if the price constantly moves up, then we can only operate on NBAMR, for example, MACD, stochastic, or RSI oscillators. Otherwise, we wait for an impulsive decline, then a correction, and decide about market entry either with sell stop pending orders or within the 50% to 61.8% range. At the moment, it's not possible, nor should we attempt to predict when the turnaround may occur. What I can impart, however, is that at the weekly option contract level, it's worth paying close attention to the 50 level. This is the HDV call level, which is a point of maximum open interest in call option contracts. This suggests that when the price reaches this level, its significance will be quite considerable. This is where the premium of these call option contracts are important, as future contracts will likely be opened in maximum volumes at premium levels. Therefore, one of the strongest resistance ranges in the world is the HDV call and their premium levels. Until that happens, respected colleagues, we just sit tight and watch what will happen with this trading instrument. Now, moving on to the Swiss franc, my personal favorite choice. Moving straight onto the weekly time frames, I can see we most likely have the initial diagonal triangle in wave O, followed by a correction, either an AC flat correction in wave number D or a correction ending here, whether in wave O or here in US, a younger order or in an older order, wave doesn't really matter much. What matters is that we see the potential movement, and to this likely downward movement, we see a bearish pin bar, a beautiful pin bar. Next, we come down to the daily time frame. The thing is, colleagues, as the price decreased, we got two bearish pin bars indicating that the bears here, specifically the professional market participants selling this trading instrument, are currently very strong. Please note that both the HDV call options and HDV put options are below the price at the moment. And now we move on to reviewing the H4 time frame. There's nothing significant here, so we jump to the H1 time frame. Here we see the likely formation of the initial diagonal of an expanded diagonal triangle, presumably in this order: first wave, second, third, fourth, fifth. Colleagues, our fifth wave is probably not yet finished. We'll likely see a correctional growth and then begin to sell. This is currently the most promising trading instrument, and it's likely that we'll be able to see this whole combination during the upcoming trading week. On Monday, the trend will go down and refresh the lowest value. Then on Tuesday and Wednesday, we'll observe the correction. And by the end of the trading week, we'll be able to make market entries for sale, if such a combination forms for us. If the price suddenly shoots up or goes very, very far down, then this combination is not relevant, and at this point, there isn't much sense in it. You can hedge your positions a bit, though. Namely, you could set pending orders beneath the pin bar's minimum. For instance, a sell stop order can be set here, while the stop loss just above the maximum would be here. The only problem may be if there's an initial expanded diagonal, as I just mentioned. The sell stop pending order would be triggered and then go into correction, and psychologically, seeing a loss would be difficult. And then, of course, the price will most likely turn around. But if you're setting a pending sell order, you're protecting yourself from the situation where the price may start dropping immediately on Monday and you'll instantly make a profit. So in both the first and second scenarios, the probability of making a profit is good, higher than the likelihood of achieving a PSA. With the latter scenario, you will have to sit tight, wait, and maybe get a bit nervous, while in the second scenario, you would make your profit within the first 3 days of the trading week. Thank you so much, respected colleagues, for listening to this seminar. Once again, I remind you that the project for automatic deal copying starts next week. I'll make an announcement about this and obviously record a video for you where I'll explain everything. Thank you all so much. Have a good evening and goodbye.